Good morning, everyone. My name is Adam Livingston, and I am the Bitcoin Wizard. Ladies and gentlemen, we're just going to cut through the noise because we are witnessing one of the most historic dislocations in modern finance history. Gold, the ancient sovereign asset, has just ripped through all-time highs like a freight train with its brakes cut, up 45% year-to-date, hitting $3,788 an ounce, and making every central banker on Earth sweat bullets. Meanwhile, Bitcoin, the apex digital predator, is hovering around 114K after reaching an all-time high of 124K. We've been seeing Bitcoin consolidate, absorb some liquidity, but mostly cooling like a compressed spring. Now, this divergence between gold and Bitcoin is not just an anomaly, it is a statistical gift. Whenever you see an asset class with a 5 sigma move while its correlated high beta cousin sits dormant, you are staring at raw convexity. Liquidity primed for rotation, market structure primed for reflexivity. We are talking about a setup for Bitcoin here with a historical beta of 7-to-1 in favor of Bitcoin, following gold lagged by about 10 to 15 weeks. This is why you guys are going to like this video today, because this is not just a chartist's mirage. You guys all know that I think technical analysis is astrology for men, but this is a quantifiable, repeatable phenomenon that we have observed since Bitcoin's inception. Every major gold melt-up in the post-2014 regime has set off a cascade where every Bitcoin doesn't just play catch-up, it blows past every single linear expectation. In 2020, a 27% gold rally led to an 89% move in Bitcoin in just 3 months and a 256% surge in 6. We are now staring at a gold rally that is twice as aggressive, with the same liquidity regime, the same monetary backdrop, and the same institutional FOMO. The only thing missing is the final domino, capital rotation from the old guard to the new. So the key question that we're all asking right now as Bitcoiners: when does Bitcoin light the afterburners? And more importantly, are you positioned before or after the fact? This is why I run the numbers, kids, and this is why the next 6 slides matter more than any CNBC segment you've seen all year. Now let's dissect the mechanics of this gold melt-up, because behind every record-breaking move is a perfect storm of flows, incentives, and systemic panic. Forget the mainstream narrative about jewelry demand or war premiums. The real story is all about institutional flows and global liquidity. First things first, the central banks are in absolute beast mode. The People's Bank of China and the Reserve Bank of India are accumulating gold at a record pace, running it up like crazy lately. We're talking about sustained net purchases above the record set in 2022. When the world's biggest creditor nations start binging on gold, you should take notice, because that means they are front-running sovereign risk and dollar debasement. Second, ETF flows have done a total 180. We saw about 100 metric tons in net inflows in just September alone. This is the first sustained ETF buying streak since the COVID panic of 2020. That means it's not retail, it's institutional FOMO. So think hedge funds, asset allocators, and insurance conglomerates that need real collateral in a world of synthetic yield and default risk. And third, we just need to look at the macro tailwinds right now. Real yields have finally rolled over. US fiscal stress right now is obviously boiling over, with every new shutdown threat reminding allocators just how fragile fiat really is. And global PMIs are pushing into the soft patch, pushing everyone toward hard assets, especially those that exist outside the system. What you're seeing is a virtuous feedback loop. The central banks buy the gold, the ETFs chase it, real yields compress, and then the price feeds on itself. This is not a slow grind. This is reflexivity at work, and it's what creates vertical moves in hard assets. When gold goes parabolic and Bitcoin is still asleep, you know the trade of the decade is about to materialize. Now, let's look how these flows set up an asymmetric opportunity for Bitcoin's next act. Now let's talk numbers, because this is where the alpha is hiding in plain sight. So far in 2025, gold is up a staggering 45%, hitting new all-time highs almost weekly. Meanwhile, Bitcoin's sitting up 22%. Despite the most bullish macro backdrop in history, it's only up to date that much. On any normalized chart, this is a once-in-a-cycle divergence, but let's get technical. The 30-day correlation between gold and Bitcoin is slightly negative right now, bouncing around 0.05 in the negative. But do not be fooled by this. This regime-dependent correlation is exactly what sets up asymmetric bets. In normal conditions, their relationship is low, almost uncorrelated. But when gold breaks out, history shows that Bitcoin tends to play catch-up, and the lag is measurable, roughly 10 to 15 weeks. Here's a key stat I want to share with you guys. The last time that gold staged a similar move, Bitcoin didn't just follow, it outperformed with a historical beta near 7-1 in the post-2014 era. That means for every 1% gold moves, Bitcoin has on average moved 7%, and right now we're sitting right on top of Bitcoin's bull flag breakout level, the 113 to 115K zone that we've been sitting in. If Bitcoin continues to close above this level with the volume that it has been, you can almost hear the starting gun for the next risk on leg. So to sum it up, gold's vertical move has carved out a quantifiable spread, with Bitcoin quietly absorbing supply at the base of a massive range. The rubber band is stretched, but when it snaps, you want to be on the right side of that mean reversion. The data says that Bitcoin is not late, it's just loading. We have seen this play out time and time again. So now let's dig into the historical playbook for more specifics, because once you see the patterns, you can size up what's coming next. This is where the magic happens, folks, where the numbers tell the story that Wall Street cannot ignore. So if we run the tape, in August 2011, gold peaked at $1,920 after a legendary meltup. Bitcoin was still a newborn baby. The liquidity was a little bit laughable, but even then, Bitcoin ripped 25% in the next 3 months and 56% in 6. Fast forward to 2020, gold hits $2,067, a 27% run up in just 5 months. What does Bitcoin do? It explodes 89% in 3 months and goes up 256% in 6 months. The median lag to the Bitcoin breakout, about 15 weeks. 8 months after the gold peak, Bitcoin is printing a fresh all-time high. Now let's quantify the relationship. I ran the lead leg stats on weekly data from 2014 to today. The peak positive correlation, about 0.24, hits when you lag Bitcoin by around 10 weeks behind gold. So the average 90-day BTC return after a gold all-time high is 58%, and the 180-day is 181%. That is not a backtest fluke. That is the statistical signature of history. And here we are in 2025 now, where gold is almost double the price that it was 5 years ago. It's already ripped 55% in 9 months, setting new all-time highs, while Bitcoin has dipped 11% in the same span. We are looking at a setup that is eerily similar to 2020, except this time the macro flows and the institutional participation are even bigger. Now you might be asking, Adam, why does this pattern persist? My answer is because capital is path dependent. When gold breaks out, sovereigns and institutions pile in, but as the move matures, capital then seeks the higher beta, the higher upside, and that means Bitcoin. This lead lag that we've seen is not just anecdotal, it is repeatable, it is quantifiable, and the window is opening right now. So when you see gold in vertical mode and Bitcoin building energy at the base, you're not late, you're in the sweet spot. Next, let's turn these stats into actual probability-weighted targets. This is where the playbook gets actionable. Let's get right to the meat. What do the numbers say about upside, timing, and risk? Based on the historical data, we can actually assign probability-weighted scenarios. The base case, supported by both the average and the median lag after a major gold breakout, gives us a window between October and December 2025. This is when historically Bitcoin lights the afterburners. If the historical beta from the last major cycle holds, that implies a target range of 160,000 to 220,000 per Bitcoin. This is not hopium. This is literally just the math anchored to how Bitcoin moves when gold leads the way. Now let's layer on the outliers. In about a quarter of cases, Bitcoin front runs the lag and rips higher in less than 8 weeks. In that fast follow scenario, you're looking at a slightly lower but still monster range of 140K to 170K Bitcoin. And finally, let's respect the downside. About a 20% chance the rally fizzles, macro shocks take the center stage, and Bitcoin stalls out under 100K into Q1 2026. This is where the risk always lives, but the skew is massively to the upside as long as gold holds its breakout. I want you to remember that these targets are not my wild guesses. These are derived from actual betas in 2020. Remember, Bitcoin moved roughly 7 times the percent gain of gold. Even if you apply a haircut for today's lower volatility of Bitcoin, you're still looking at very explosive potential. So what's the game plan? Well, if you want an asymmetric payoff, you position before the beta catches up. The moments that the capital rotates from slow gold to high beta Bitcoin, that's when the price goes vertical. All the data says when this window opens, you want to be holding, not chasing the gains. Let's talk about what signals will tip us off that the move is beginning, because timing the rotation is everything. This is where we move from theory to execution. If you want to capture the full upside, you need to watch the tripwires, the quantifiable signals that historically front-run Bitcoin's explosive moves after the gold meltups. First, you obviously have to watch the price action. The key technical level is a Bitcoin close above 114K. This is not a random number. It is the multi-month bull flag ceiling, a structural breakout point. Once the price clears that level, the market structure then shifts and the probability of a major momentum leg jumps. Second is to monitor the ETF flows. When spot ETF net inflows exceed $500 million a week, that's not just retail buying, that is deep pocket institutional capital repositioning. Historically, this kind of flow precedes Bitcoin's biggest vertical moves. Third, keep your eye on global liquidity. The US dollar index, the DXY, dropping below 96, and the 10-year TIPS yield falling under 1%. This is the same liquidity cocktail that powered both gold and Bitcoin in 2020. When liquidity floods the system and real yields then compress, hard assets catch a bid and Bitcoin gets rocket fuel. And finally, we just need to track the cross-asset correlations. The 30-day correlation between Bitcoin and gold rarely spikes, but when it does, especially above a 0.2, it signals a synchronized risk-on regime where capital is flowing into both assets at size. The point is, these are not gut feel signals. They're quantifiable, public, and actionable. If you're waiting for TV to tell you that Bitcoin is in play, you'll be late by definition. If you're watching these metrics, you'll see the capital rotation in real time as it happens. Timing the rotation is a data-driven exercise. These tripwires give you the edge, so you're not guessing, you're front-running the move. On the next slide, we'll talk about how to actually execute, how to size your bet, manage risk, and ride the asymmetry. But remember, this is not financial advice. This is financial entertainment. This is where everything comes together, your actionable roadmap for maximum upside and minimum regret. First, gold has obviously fired the starting gun. Central banks, sovereign wealth, and institutions have voted with their wallets. Capital is moving into hard assets at record speed. The market is screaming for an exit from fiat risk, and Bitcoin is the only asset with the volatility, beta, and scarcity to take the baton from gold. Second, I want to stress that the timing matters. The historical 10-week sweet spot is right in front of us. The quant window is open from October through January. If you're not positioned before Bitcoin breaks out, you're handing the asymmetric returns to someone with more conviction and better data. And remember, kids, especially you proper degenerates out there, you need to remember sizing and risk. This is not a buy and hope environment. It's a position for convexity setup. If you view Bitcoin as just another investment, or if you want to trade it, you need to survive the whipsaws, but don't be so conservative that you're gonna miss the power law returns. The upside math is quite explosive even after a vertical gold move. The historical beta says that a $400 increase in gold maps to a $40,000 or $60,000 move in Bitcoin. If gold pushes from $3,800 to $4,200, Bitcoin's quant target opens from $160K to $200K, and every past cycle has delivered this convexity, just at different speeds. Gold has already rung the bell. The capital is coming and the setup is asymmetric. The data does not care about narratives. It cares about liquidity, correlation, and price action. If you're serious about performance, you position before the narrative catches up, not after. This is how quants eat the lunch of legacy allocators. The playbook is very simple. Track the signals, manage your risk, and front-run the rotation, because if you wait for permission, you'll be paying the premium, not collecting it. Thank you so much for listening. If you like this content, please like this video, subscribe to the channel, help me spread the orange gospel to the masses. Have a terrific day. Do not party too hard. Class dismissed.